Hi guys, and welcome to this second take of the recording of a walkthrough of the model answers for your second assignment. So I'm going to go over to the shared documents now so that I can go through those with you. Okay, so here we go. Question 1, 15 marks. This one was mostly all about VAT from your Learning Unit 3. So question 1.1, name the two ways, and they put in brackets their bases that a company can register for VAT. So if you go to your learning objectives for Learning Unit 3, you'll see that one of the learning objectives is that you need to know the difference between the payments basis and the invoice basis. And in your textbooks, there's a whole section on that on page 83, section 3.4. So there should be no excuses if you're using your textbook and you're consulting your learning objectives, why you guys didn't immediately know what they were talking about in that question. So payments cash basis, half a mark for mentioning and 2 marks for describing, and invoice basis, half a mark for mentioning and 2 marks for describing. So that's what we needed in that one. Then the question 1.2. This was a very interesting question and one that really tests whether you guys know your supplier categories properly, which is really what this is testing. Which VAT supplier category, that's what they're asking, will apply for each scenario. Okay, and then give a reason for your answer. Then also, please make sure, again, as I always say, answer all parts of a question if input VAT can be claimed or not by the tuck shop. So you had to state what VAT supplier category does it belong to? Why did you come to that conclusion? Can input VAT be claimed back by the tuck shop on this purchase or not? Because remember, this question is about a tuck shop, and they are buying products to use in their tuck shop. Okay, so we know that as a VAT registered vendor, all purchases that you make, if they are standard rated purchases, in other words, VAT was charged to you when you made that purchase. If it's a standard rated supply, you can claim that VAT back from the receiver. If it's a 0 rated supply or an exempt supply, there is no VAT included in that purchase that you made. So therefore, you can't claim VAT because there was no VAT charged to you in the first place when you made the purchase. And then the fourth instance is if it is a standard rated supply and VAT was charged to you in the invoice, but because of the nature of what you are going to use that item for, you are not allowed to claim. In other words, it's a non-allowable item. You're not allowed to claim the VAT back. Okay. So in scenario 1, it was white bread that was purchased by the tuck shop. Okay. So immediately we know which VAT supply category. White bread belongs to the standard rated VAT supply category. VAT is always charged on white bread. When you buy white bread, VAT is included in that purchase price. Okay. So that's your supply category and the reason. It's a standard rated supply. And then, can that be claimed or not? So we have to look at the circumstances of what the shop is going to use that white bread for before we can make that decision. So they're going to use this white bread to make sandwiches, which they are going to sell to students on campus. So because they are going to use that white bread in making a product, a value-added product, a sandwich that they are then going to sell as part of their business operations, that means that that white bread is a valid business purchase, which means they are allowed to claim that input VAT. Then in scenario number 2, it is white bread flour that they purchased. I did include in the information that I gave you about the assignment a link for those, which I think we've now got 21 0 rated items in South Africa, and white bread flour, in actual fact, any kind of flour that you purchase there is now a zero rated item. So you needed to go and do some research, which I said in the question. White bread, which is a finished processed product, is not the same thing as flour, which is basically a raw material that we are going to use to make bread and cake and muffins, etc. out of. White bread flour used to be a standard rated item because it was still put in the category of being white bread, which, because it's a processed unhealthy product, that's why the receiver doesn't want us to use it. They want us to rather use brown bread and brown bread flour, which is why brown bread and brown bread flour was zero rated before. But in, I think it was 2018, they've added white bread flour to the zero rated products because a lot of people don't buy bread or any types of breads, etc. They buy flour, which is cheaper, and then they make their own bread. So that was added to the zero rated items. So because white bread flour is zero rated, the question, can input VAT be claimed or not? The answer is no, because it's a zero rated item. We didn't pay VAT on the item, so therefore there is no VAT to claim. So it didn't matter in this case what they were going to use the white bread flour for, because whether we used it in this case to make muffins to sell to students, which means we are adding value to the white bread flour and using the flour in our business to produce a product that we're going to sell in our operations, there's still no VAT to claim back because it's a zero rated item. So even if we were going to make the muffins and consume the muffins ourselves, that would be a non-allowable usage of the input. But even then, it would be irrelevant because there's no VAT charged on white bread flour. Scenario 3, brown bread purchased by the tuck shop. So first of all, straight up, what VAT supply category? Brown bread is, again, automatically, it's a zero rated item. So again, automatically, can input VAT be claimed or not? No, input VAT can't be claimed because it's a zero rated item. The business didn't pay any VAT, so therefore there is no VAT to claim. Again, they used the brown bread to make sandwiches that they were going to sell to students, which also means they used the brown bread in a valid business expense, which means if it had have been a standard rate of item, they would have been allowed to claim the VAT back. Because it's a zero rated item, there is no VAT to claim back. Then scenario 4, white bread. So again, we go back to scenario 1 where we purchased white bread. So remember, we know automatically white bread, there's always VAT charged on white bread when we purchase it because white bread is a standard rated item. It's a processed food. Shops have to add VAT to the purchase price of white bread. But can we claim that back or not? We have to have a look at what did the shop use the white bread for before we make that decision. In this case, they made sandwiches, but they made the sandwiches for tuck shop staff to enjoy during their breaks. So this means it's a standard rated item. We paid VAT, so there is input VAT included in the purchase of the white bread, but we may not claim that VAT back because we consumed that white bread ourselves. We were the end users, the end consumers of that white bread. We are not using the white bread to add value to another product that we are then going to sell on in our business. We bought the white bread, we made samis, we ate the samis ourselves. Not allowed to claim the VAT back. It's a non-allowable item because that would then be classified under the entertainment category, so non-allowable. Okay, so hopefully the discussion of how to make your decisions to make sure you answer all parts of the question that they asked you is going to help you, because a lot of students in this question, they got part of the questions right, and then they lost it halfway through. They either didn't answer everything that was requested, or they got muddled up between when they had to decide whether they could claim the VAT back or not. So remember, whether we can claim the VAT back or not depends on two things. Number one, were we charged VAT in the first place? And then secondly, what are we going to use that product for if it's a standard rated item? Okay. So hopefully that is going to be of help to you. Then in our question 2.1, everybody's favorite questions, and this is calculate the missing amounts and show all your workings. Guys, I'm always telling you, make sure you follow all instructions. Please, for the exams, follow instructions. If they say show your workings, you must write your workings down, because that's the way that you can get some method marks. Round to 2 decimal places. If they tell you to round, you must round, because that's what's required in the memo. And they said ignore VAT, which is telling us that in this question, we must pretend that these transactions were for a non-registered VAT vendor purchasing from a non-registered VAT vendor. In other words, no, VAT never entered into this question at all. So we just had to do our calculations. Okay, so I did do a practice question with this identical type of question last week that I posted for you guys. It was our NSS. In our NSS session, I went through in detail a question showing you how to calculate the cost, the profit, or the selling price if the markup is on cost, and how to do obviously the same calculations if the markup is on selling price. I'm going to just tile these so that I can see, whoopsie, you can see them next to each other. There's our question, and here are our answers. Okay. So, what I told you last week as well, our basic, sorry, let me just, I don't want to underline, I don't want to, sorry guys, let me just find, there we go, I want that text. Selling price, okay. How do we calculate our selling price? Cost price plus the profit that we want, because we have to always sell our goods for more than what it cost us, otherwise why are we in business? So our selling price is always what those goods cost us to either purchase or manufacture, plus the add-on that we want to make a profit for ourselves. So cost plus profit equals selling price. That little, I don't even want to call it a formula, it's just a little calculation, will always be exactly the same. Cost plus profit equals selling. Well, that will never change regardless of whether we are marking up on cost or we're marking up on selling. We are always going back to the fact that this is the sum that we are doing. Cost plus profit equals the selling price. That's very important. Then in this first instance, they say our markup is 25%. Oh dear me, I don't want that. I don't think that's going to undo that. Sorry guys, I'm just getting myself muddled up here. I don't want all this highlighted, not that it's going to make much difference, but anyway, there we go. Okay, our markup is 25%. So we go straight to the profit column, and we know that our profit is, where am I? Here, is 25%. Okay. Then the next thing we want to know is 25% of what? Is it 25% of cost, or is the profit 25% of the selling price? Here they said we want the profit is going to be 25% of the cost price. So if we take our sum, cost plus profit equals sell-in, cost plus profit equals selling price, we are going to have 100% of the cost plus 25% profit, because profit is 25% of the 100% base, which is going to be the cost, which means our selling price is going to be 125% of the cost. And our cost in this example is going to be 100%. Okay, now we've got our proportions. 100% plus 25% equals 125%, because our profit is 25% of cost. So whatever the of is our base, and our base is always 100%. That's why we wrote 100 under cost, we wrote 25 under profit, and we said 100 plus 25, 100 plus 25 equals 125 to get our selling price. Now that we've established that, we can go and do our calculations. So what have they given us? In this case, they've given us the cost price. And we need to work out the profit, and we need to work out the selling price. So you always start with the rand value of what you've got, because, sorry, I am still in text. So if you look at, I'm doing the calculations at the bottom. So 5,000 rand, that's what we know, okay? 5,000 is 100%. So I want to divide that by 100, which will then tell me how much 1% is. Because if 5,000 is 100%, if I divide 5,000 by 100, my answer will be how much 1% is. When I know how much 1% is, I can then multiply that value by 25 to get my profit, and I can multiply that value by 125 to get my selling price. So you can do it like this, either 5,000 divided by 100 multiplied by 25 equals 1250, or you could use this math, 5,000 multiplied by 25 over 100 equals 1250. Oopsie, sorry, I've got an extra, oh dear me. Okay, I can't get that other 5 out there now. Okay, let me just go back there. I don't want to muddle anybody up. 25 over 100 equals 1250. Okay, both of those is the identical maths. In this second calculation that I did here, this one, we've got 5,000. Because the 100 is at the bottom of our fraction, divided by 100, we are 5,000 divided by 100, and then here we've got multiplied by 25. But in maths, we write it as 5,000 multiplied by 25 over 100. It's exactly the same thing as saying 5,000 divided by 100 multiplied by 25. When I was first learning these fractions, I used this first method because I could follow exactly step by step what I was doing. My brain always understood. If I divided it by 100, I always wanted to work out how much 1% is, because as soon as I know how much 1% is, I can multiply that 1% by whatever the value is that I want, and I know without fail I'm going to get the right amount. Okay, so if you can't remember this, excuse me, this maths in the second one, then just use the first and try it out on a piece of paper in your calculation at home, both methods, and you'll see, you'll get the exact same answer. Okay, so then we've now worked out A, the profit. The selling price is now also what we want to work out. So we already know the cost price is 5,000. We know that the selling price is 1250 because we've now worked that out. So because we know cost plus profit equals selling, we can say 5,000 plus 1250 equals 6250. Because we already know what A is, and so because we know what A is, we can quickly work out what B is. if you wanted to use the maths to work it out, identical method, you could then say 5,000, because that's the amount that we know, divided by 100, because we want to know how much 1% is. And then because we now want to work out what the selling price is, we want 125% multiplied by 125. And when we do that, we will get the 6250. Or you could have said 5,000 multiplied by 125 over 100, and that will give you 6250. Okay, then let's do an example of markup on selling. So exactly what we've done here for this first one on cost, you would do the identical maths for this one here, the 30% on cost. So let's just go and have a look, because the only difference here in this example is that instead of giving us the rand value for the cost, they have given us the rand value for the selling price. Okay, so let's just again go and apply our exact same principle. So first thing we say, how much is the markup? It's 30%. So immediately under the profit column here, we are going to write 30%, because I know my profit is 30%. Question, 30% of what? It is 30% on cost. Here, 30% of cost, which immediately tells me that if it's 30% of cost, my cost is my base, and your base is always 100%. So my cost is going to be 100%. Then I do my sum. Cost 100% plus profit 30% equals my selling price. So my selling price must be, I've got space to put it in here. My selling price is then going to be 130%. Okay. So what we start out with the rand value of what I know, the amount that I've got, which is 20367. Okay, that's what I've got. So I have to start with that. So 20367 divided by, and in this case, I've got to divide it by 130, because 20367, that amount is 130%. So if I want to work out how much 1% is, I need to divide 20367 by 130. And then I multiply it by, if I want the cost price, I multiply that by 100, because my cost is 100. And that's F, so we should then have got 15,666.92. And please, guys, take note, they said 2 decimal places, so give me 2 decimal places. Or you could have said 20367 multiplied by 100 over 130 equals 15,666.92. Okay, so we always divide the rand value that we've got by the number of parts that it is. We already worked out here that the 20367 is 130 parts. So the 130 must go at the bottom. And then what goes at the top is the number of parts that I want. So I've got 130, that goes at the bottom of my fraction. I want 100 parts to work out F, and I want 30 parts when I work out G. So if I want to work out G, which is the profit, I take the rand value that I've got, 20367, I divide it by the number of parts that I've got, which is 130, and I multiply it by the number of parts that I want, which for the profit is then 30. So my value for G is then going to be 4700.08, or 20367 multiplied by I want 30, so that goes at the top, and I've got 130 that goes at the bottom, equals 4700.08. Okay. So hopefully you've understood that. Then I'll come back to these gross margin percentages here in a minute. I just want to finish working out these markups on cost, etc., before we do anything different. Okay, so those are our two markup on cost calculations. Then if we go to oh, not that one, I want to take that one off. Okay, so we did that one and we did that one. If I want sorry, it's going to change my color quickly. Now I want my next one is going to be markup on selling. And this one is, it says the markup is 12%. No. There we go. Sorry, that did not. Just ignore me when I'm trying to do these highlights. It doesn't always highlight exactly what I want to. There we go. Okay, 12%. So again, how much is, what percentage is the markup? The markup is 12%. So you go to your profit column and we type in, am I going to have a space? We type in 12%. Okay, my profit is 12%. Then we say 12% of what? It's 12% of the selling price. So next to the in the selling price column, we are going to write 100%. Okay, because whatever the profit is a percentage of is our base that we start with, and our base that we start with is always 100%. So because it's a markup on selling, the profit is 12%, but it's 12% of the selling price, which means my selling price was my starting point. My starting point must be the 100%. And to that, in this case, I'm not adding 12%. The profit is 12% of the selling price. So have a look at our calculation at the top here. If selling price is 100, which it is here, and if my profit is 12, which it is in this instance, my sum, cost plus profit equals selling, has to be true. So I've got X plus 12 equals 100. So to work out what X, i.e. cost is, I've got to take 100 minus 12, which means that my cost is going to be 100 minus 12 is going to be 88%. Is my maths right? 88. So I've got 88 plus 12 equals 100. 88 cost plus 12 profit equals 100 selling price. Okay? You have to get those proportions, those percentages written down first before you try and do any maths. And then we're going to do absolutely exactly the same maths that we already did with the previous two. You start out with the rand value that you have been given. So in this case, we've got to start out with 1245. How many percentages is the 1245? It is the profit, which is 12%. So to calculate 1%, I must divide it by 12. Now I've got 1%, and which one do I want? I want cost price, which is 88 parts. So I multiply, divide by 12, multiply by 88, and that gives me my value for D is going to be 9130. Or we can say 1245 rand multiplied by, and at the top must be what I want, which is 88, and at the bottom of the fraction must be what I've got, which is 12. So 88 over 12 equals 9130. And you can always check, because my cost, yeah, you can't always say the cost is not always more than the profit. Sometimes the profit that we add on is more than the cost. But in this case, we can see my my selling price was 88 and my profit was 12%. So the answer that I get for my cost price must be more than my profit, because my profit is only 12% of the selling price and my cost is 88% of the selling price. So we can double check. My profit was 1,245 Rand, 12%. My cost is 9,130 Rand, which is 88%. So I can see that the answer I got for my cost is a higher Rand value than I started out with for my profit. So I can see, yes, okay, my maths is probably the right way round. Okay, so let's do the selling price. So the selling price is 100. So you, now that you've got your cost, 9130, we can take 9130 plus 1245. Okay, 9130 cost plus 1245 profit equals E10375, which is obviously the quicker way to do it. If you want to use the maths, we can say 1245, which is my profit, divide that by 12 to get 1%, and then multiply it by 100 if it's the selling price that I want. And then you should get 10,375. Or 1245 multiplied by, at the top of my fraction must be what I want, which is 100, and at the bottom of my fraction, over must be what I've got, which is 12, equals 10,375. Okay, and then obviously for these other two on the selling price, you'll do exactly the same that we've just done with this one. Going over to another page, is this going to work? Can you still see? Hopefully you can still see what I'm doing here. If we do one more, this one, the markup is 75%. It's also on selling. So I ask myself, how much is the markup? It's 75%. So in the profit column, I write 75% because the markup is the profit. Markup, profit, those words mean the same. So the markup is always the Rand value of the profit. Then we, in this case, we want to say 75% of what? 75% of the selling price. So the base that I start out with when I do my markup calculation is going to be the selling price. So my selling price is then the 100%. Now, how much percentage will the cost be? Cost X plus profit 75 equals selling 100. So to work out what the X for cost is 100 minus 75 equals, my cost will be 25%. So I write 25 in the cost column. Now I'm set up. I know 25 plus 75 equals 100. Okay, that looks right. And now let's go and do the maths. So we start out again. They have given us the 500. In this case, they've given us the Rand value of the cost price, and then we have to work out the Rand value of the profit and the Rand value of the selling. So we always have to start out with the Rand. I don't know if this is going to work. Oh dear, sorry guys. Let me just go back. I'm going over down to the next page. So I can't, for some reason, I can't type anymore. Okay, so I'm just going to talk you through it. All right. We start out with the 500 because I've got 500. So it's going to be 500 divided by 25 because 500 is 25%. So I want to divide it by 25, which will give me the value of 1%. And then I will 500 divided by 25 multiplied by 75 to get the profit rand value. 500 divided by 25 multiplied by 100 to get the selling price. Or you can say 500 multiplied by what I want at the top, 75 over 25, which is what I've got. Okay. Or we can say 500 multiplied by what I want at the top, 100 over what I've got at the bottom, 25. And you can see what the rand values are that you should have got here on the right-hand side of the screen. Okay. You guys think you're going to be okay with those? And guys, again, this will never change. Cost plus profit equals selling price. That's your secret. That's what your sum is always going to be. It always has to be true, because that is cost plus profit equals selling. It's that's true. So your maths always has to equal whatever we've got over there. What else? Oh yes, these two over here, when they've asked us to work out the gross margin percentage. When we talk about a gross margin, that terminology always means that we are referring to the profit as a we are always referring to the profit as a percentage of the selling price. When we are talking, use the terminology gross margin. Gross margin always means profit over selling price multiplied by 100 to convert it to a percentage. So when they say over here, what is your gross margin percentage? You are always going to work out profit as a percentage of the selling price. So easy is, we know that the, sorry, I'm trying to find a place where I can write. Profit is 25%, selling price is 125%. So if we take 25 over 125, that equals 20%. So our gross margin percentage is 20%. And then over here for H, gross margin percentage, what is the profit as a percentage of the selling? So in this one, sorry, I just can't get to did I click on text? Oh, didn't click on text. Go up there, can I go down? We want to work out H, so profit as a percentage of the selling price, 30 over 130, 30% over 130, and that one equals 23%. You could also have taken the rand values, so it doesn't, you don't have to, in the memo they've got 25 over 125 equals 20 and 30 over 130 equals 23. So we've used the percentages, but you already have got worked out the rand value, so you could also have worked out your gross margin percentage using the rand value. So for C, profit, which is A, let me write it over here on this side. You could also have said, or profit, which is the value for A, which is 1250 over the selling price, which is B, which is 6250 in rand value, and you'll still get 20%. And for H, in this one over here, instead of using the percentages, we could have used the rand values. So here, G is our profit. So your rand value for G is 4700.08 over the selling price, which is 20367. and you would also have got 23% there. Okay. So those things don't change. Cost plus profit equals selling price has to be true. And for gross margin, it is profit as a percentage of the selling price, regardless of whether we work the rand value of the profit out by taking it as a markup on cost or a markup on selling. When we work out gross margin, it's profit as a percentage of selling price. Okay. So I hope that has helped you to practice those again, because I know students continuously battle with those. And then 2.2, if you can still see it on the page over here, what is the markup percentage on a profit, on a product, if the corresponding gross margin is 75%? Round to 2 decimal places. So think about that. They've said that the gross margin is 75%. So remember, we're using this principle here, cost plus profit equals selling price. Gross margin is 75%. So that means our gross margin profit is 75%. When we talk about gross margin, we are talking about the profit as a percentage of the selling price, which immediately means the selling price is our base of 100. So now I know that my gross margin is 75 of my selling price. So selling price is 100, which means that my cost, going backwards here, must then be 25%, because 25% plus 75 equals 100. Okay, gross margin is 75, so we write 75 in the profit column. Because it's gross margin, it means it's 75% of the selling price. So selling price is 100. So our missing number is 25. Okay, over there. So now we've got 25 plus 75 equals 100. And then they said, what is the markup percentage? So markup means percentage. What profit is the what percentage is the profit of cost? When we use the terminology markup on its own like that, we mean markup on cost. Okay, so they've said markup on selling is 75%. What is the markup on cost? We've got our proportions here. So what is the profit? When we say what is the markup on cost, we take our profit as a percentage of the cost. So where are the workings? On the right-hand side, we want 75%, which is our profit, as a percentage of the cost, which is 25, and that gives us 300%. So 75 profit over cost, which is 25, equals 300. 75 over 25 equals 300. But you had to work these proportions out first in order to be able to get that right. I saw some students on their papers did these long, about 4 or 5 lines worth of calculations with all sorts of conclusions and therefores, etc. You either got that from AI, which I suspect for a lot of the students is true, because I can recognize the language that ChatGPT uses. Keep it simple. This is quite simply, you work out these proportions and you can show your workings on the paper. And then this is really just basic maths that you've got to practice here. Okay, so use this here to practice backwards and forwards, backwards and forwards. Same thing with your VAT markup and your VAT, your including VAT and excluding VAT and VAT amounts. They're exactly the same as a markup on cost. A markup on cost is the identical calculation to your VAT calculation, because with VAT we are saying 15% of the basic selling price we are adding to the basic selling price in order to get, sorry, the basic cost price in order to get our selling price. So for your VAT calculations, your base your basic selling price before you've added the VAT is the 100. You're adding 15% markup in inverted commas to that, which is your VAT, giving you a selling price of 115%. And again, those are your three percentages. 100 plus 15 equals 115. That is true, and it must always be true. And then you can use those percentages or proportions to calculate whichever one they've given you. You can then easily calculate the other two missing numbers using these exact calculations over here. These first two that I did here with markup and cost, excepting you're using these percentages if you're doing VAT calculations. Okay. Give me 1 second. Okay, I'm just checking that everything on this side is still fine. Good. All right, question 3. This one, your answer will obviously depend on what invoice you included in your assignment. So everybody's answers would be different. You had to take the VAT registration number of the company whose invoice you got, name and VAT registration number. And then again, just reading carefully, what is the total amount? Okay, take note. Some people, worked out, I don't know, they didn't do the totals. They worked out some strange amounts. The total amount on the tax invoice of the excluding, the including, and the VAT on that invoice. Okay, total, when they say amount, we want a rand value for excluding, including, and rand value of VAT. Are there any zero-rated items? So there would be zero-rated items if you had, say, for instance, gone and bought stuff from a supermarket and you had fresh fruit and vegetables or brown bread included on your invoice. Then those are the most common zero-rated items on invoices. And then the invoice you're submitting, is it a full or an abridged invoice? And give a reason for your answer. So where's my textbook gone? You must go to your textbook on page 85, 84 and 85. And that will then tell you what items there must be on an invoice for it to be a full tax invoice. So it doesn't matter. You can have a full tax invoice if the invoice is less than 5,000 Rand. So you can have an invoice for 50 Rand and it can still be a full tax invoice because it's automatically a full tax invoice if it includes all of that information on page 85. Okay. The rule or the law is that if the invoice total exceeds 5,000, then by law, the company has to issue a full tax invoice. But you can be a company that your accounting system automatically produces full tax invoices for all of your transactions, and it'll just always produce a full tax invoice regardless of what the Rand value is. Okay. So just go and make sure you understand that the full or abridged is what information is on the invoice, not what the Rand value of the invoice is for. And then complete the table. Input VAT is going to be a current asset because you are going to claim that VAT back from the receiver, which means the receiver owes you that money. And anybody who owes you money is a debtor. And we know that a debtor is an asset and an asset is a debit balance. So a current asset and that will be a debit balance. And then exactly vice versa for output VAT will be on the invoices that we are producing and selling to our customers. When we charge output VAT to one of our customers, that means we are collecting VAT on behalf of the receiver of revenue. So we are charging the customer the VAT, collecting it from the customer, and then we are paying it to the receiver. So we owe that money to the receiver, and any money that we owe to somebody else is a liability, and dead click liabilities are always credit balances. Let's see if I can get more of this to fit onto the screen. Okay, I won't fit all of this onto the screen, but we'll do our best. I might go back to, okay, so here we go in question number 4, bookkeeper of uni stores. Owner is Gift Satoli. You need to take note of the owner's name. We are a registered VAT vendor, and we only trade with registered VAT vendors. So that means all transactions will include input and output VAT unless VAT is not applicable for the reason of the transaction being that we purchased a zero-rated or an exempt item from some or other vendor. 15% VAT, all amounts are inclusive of VAT unless VAT is not applicable. VAT will not be applicable only if it is zero-rated or exempt item, or if it is an item that we can't claim the VAT back because it is an entertainment expense or some other non-allowable expense. Source documents for March necessary for preparing the journal. So what did they ask us? We go down to the required 4.1, analyze each of the cash receipts. And guys, they gave you the dates, the 3rd, the 8th, the 11th, and the 23rd. But they said only the cash receipts on those dates. And then we had to fill in the cash book receipts. So we want the transactions for the 3rd, the 8th, the 11th, and the 23rd that belong in the cash book receipts. So on the 3rd, there's 2 transactions. The first one on the 3rd, Gift made an additional capital contribution. So that means money was paid into the business's bank account. So that is a receipt. This transaction here on the 3rd, our business purchased trading inventory from another company. So we paid that money to somebody else. That is not a receipt. That is a purchase. So that one will not belong in the cash book receipts. It will belong in our, for cash, it will belong in our cash book payments. So a lot of students put that in just because it said the 3rd. You must read everything carefully. The 3rd, the 8th, the 11th, and the 23rd. So those are the 4 transactions that you should then have entered into the cash book receipts. Okay, so I'm going to go past the date column because we know what those ones are. We need to know what the name of the account is that will be debited and credited, and then we need to know the rand value by which assets, owners, equity, and liabilities will increase or decrease. So you have to put the plus or the minus in front to indicate, is owner's equity increasing? We put a plus. Is owner's equity decreasing? Then we must put a minus. Okay, very important, those pluses and minuses, otherwise you can't get that mark for that particular amount, even if you got the amount correct. Remember also that what we want here, it says the account debited. So we want only the name of the general ledger account. If you go to your textbooks, I used to always know this page off by heart. It used to be page 50, but it's now page 52. Chart of accounts. That is what the name of the general ledger account looks like. It's also the name that will appear on the trial balance and the name that appears at the top of each T account in the general ledger. What it is not is a description of what you bought or who you bought it from. Okay. The account, general ledger account name. That's what must go there. Okay, so gift made a capital contribution. As soon as we've got a transaction that is between the business and the owner of the business, we are going to use one of the two proprietary accounts and nothing else, which is either going to be capital or drawings. We use capital if the owner is contributing goods or cash to the business, and we use drawings if the owner is taking goods or capital from the business. In this case, the owner is contributing, and in this case, it is cash going from her bank account directly into the business's bank account. So our two accounts involved will be capital and bank, because our bank account is increasing. Bank is an asset, and because the bank account is increasing, we're going to debit. Remember, dead click. Put this at the top over here. If I got space. Please, when you've got a question like this at the top of your table, on your paper, write dead click. Remember, you can write whatever you want to on there that's going to help you to get the answers right. Write dead click at the top. Write across the top here, general ledger account name. All these little things to remind yourself that you are going to do the correct thing. And at the top of these columns here, you can write plus, minus, to remind yourself that you must include a plus or a minus in front of the amount when you put it down. Bank is increasing, and then the owner's capital. So the owner is contributing more capital to the business. So the amount of capital that the owner contributed to the business is increasing. Capital is one of our click accounts, which means when that increases, we credit it. So the account that will be credited is capital. So increase the asset bank and increase the capital account by 10,000. So assets plus 10,000, owner's equity, because remember owner's equity is, I've got space here. How we calculate owner's equity is capital minus drawings. Let me use brackets. Capital minus drawings plus income minus expenses. Okay, that's the sum to work out owner's equity. So also put that at the top so that you know, as soon as we use a capital account, drawings, income, or expense account, it's going to affect owner's equity. Then our next one on the 8th, cash sales. So again, it's cash, which means bank account, okay, is going to be affected because we're putting cash into our bank. And we sold books. So the total, excluding VAT, of the sale is 28,200. So what amount would go into our bank account? When our customer pays us, they pay us the amount including VAT. So 28,200 multiplied by 115 is the rand value that went into our bank account. So again, bank is increasing. We are debiting bank. And sales is increasing because we made a sale. So the rand value by which bank is increasing is the including VAT amount. The rand value by which sales is increasing will be the 28,200 excluding VAT amount. Owner's equity is increasing by the rand value of the sale excluding VAT. And why is that? Because the VAT belongs to SARS. So we must put the VAT under liabilities. And you all got this correct at the top here. Everybody got this right, that output VAT is a current liability that gets credited when we make a sale and output VAT increases. Okay. So whenever we've got a sales transaction and we are a VAT registered vendor, bank or debtors control will increase by the including VAT amount, sales will increase by the excluding VAT amount, and output VAT will increase by the VAT amount. So 28,2 plus 4230 equals 32,430. So the left-hand side of my accounting equation must always equal the right-hand side. So the left-hand side of my accounting equation is assets. The right-hand side of my accounting equation is owner's equity plus liabilities. So on the left-hand side here, which is assets, I've increased it by 32,430. The right-hand side of my accounting equation has also increased by 32,430. That has to be true after every transaction because our sum, assets equals owner's equity plus liabilities, has to be true all the time. That accounting equation always has to balance, which again helps us to write the correct amounts under the right column, because all we've got to do is to check when we're finished, does the left-hand side of my accounting equation still exactly equal whatever I've got on the right-hand side? If I decrease the left by 10, I must decrease the right by 10. If I increase the left by 32,430, I must increase the right-hand side by 32,430. So you've got to remember all your rules. You've got to remember your VAT rules. You've got to remember your accounting equation rules. You've got to remember your dead click rules, which accounts increase on a debit side, which accounts increase on the credit side. And then what happens when we make a sale? Sorry, just 1 second. I just need to take a drink. Taking a drink sounds bad. It is only tea. So I've always told you guys that whenever we have got a sale, there are two, and we are using the perpetual inventory system. There are two transactions that we have to record when we make a sale. Only one of them being the actual sale rand value itself, which is what we've just recorded now. The sale amount, and then the output VAT amount. The second transaction is we now have to update our inventory general ledger account, because inventory movement has taken place because we sold some of our inventory. Okay? Which means we've got to decrease our inventory account to remove the inventory that the customer went home with. And we have to increase an expense account because we incurred an expense in order to make that sale. And that expense that we incurred is called our cost of sale. So cost of sale is an expense account which increases when we make a sale, and inventory account is an asset account which decreases when we make a sale. So expense gets debited when it increases, and an asset gets credited when it decreases. Okay. Asset increases on the debit side, which means it will decrease on the credit side. Then what rand value is our cost of sale? So what did they tell us here? All books are sold at a markup of 25% on the selling price. What is our rule? I don't know if we're going to fit this all on here. Let's just try. Remember the rule we just practiced before. Cost plus markup equals selling price. If my markup is 25% of the selling price, then my cost is going to be 75%, because 75 plus 25, my selling price must be the 100, the base. My markup is 25% of selling. So selling gets the 100%. So because the equation cost plus markup must equal selling, 100 minus 25 means my cost is 75. So now we know that my cost of sales is 75% of my selling price, and it must be of the excluding VAT amount. So if you look over here on the right-hand side, 28,200, which is my sales value excluding VAT, multiplied by 75% is then my cost of sales. So my asset inventory is decreasing, and my owner's equity is also decreasing, because when I incur an expense here, income minus expenses, expenses has got a minus in front of it. So when I incur an expense, it decreases my owner's equity. Okay, so don't forget, when we've got a sale and we are using the perpetual inventory system, journal entry number 1 is record the sale at sales value, and journal entry number 2 is record the cost of sale at the cost price. Then on the 11th is another cash sale, and in this case all goods are sold at a markup of 25% on the selling price, so exactly the same as we've got up here. And in this case they've given us the including VAT amount. Read carefully. They gave us that excluding VAT, they gave us this including VAT. So this sales amount is already the sales rand value that we would receive into our bank account, because it's a cash sale, and it is here. So on the 11th, bank is going to increase by 2280, because we deposit the full invoice amount that the customer pays us, which is always the including VAT amount. And then we've got to do our calculation to work out the excluding VAT amount, which is our sales value, and which portion is the VAT. So we've got to split the including VAT amount, 2280, between the sales portion and the output VAT portion. That is always 15%. This amount over here is the including VAT amount, which means it is 115%. The sales is going to be the 100 portion, and the output VAT is going to be the 15%. So that we can say, we can say that 100 plus 15 equals 115. And then if we want the sales amount, we've got 2280, which is 115. So we start with the rand value that we've got, 2280. We divide it by the percentage that it is, which is 115. And then we multiply that answer by 100 to get the sales value, or by 15 to get the output VAT amount. There's obviously other maths versions you can do to get the same thing as well. Here they've given us 2280 divided by 1.15 to get the excluding VAT amount, and then all we do is take 2280 minus 1983, and that gives us the output VAT, because remember, 15 plus 100 must equal 2280. And then again, cost of sales, same calculations we did before. We have to use the excluding VAT amount, the 2280, times 75% to work out. Sorry, oh, this memo, I remember now, it had an error on it. This was wrong. The correct answer is 1983 times 75% equals whatever the answer is. I don't have it in front of me now. Okay. Cost of sales has to be worked out on the excluding VAT amount. because the very first thing we do when we make a sale, record the sale, debit the bank account or debit debtors control with a full including VAT amount. Then split that sales amount into excluding VAT and VAT. The VAT immediately goes to the VAT column, to the output or the input VAT, because that is either going to be paid to SARS or claimed back from SARS. And the excluding VAT amount is then either our sale amount or our expense amount. And we use the excluding VAT amount to work out the cost of sale, because the cost of sale is our expense, and our expense will obviously be calculated on the excluding VAT amount. So debit cost of sales to increase expenses and credit inventory to decrease assets by that amount. Then on the 23rd, we received quarterly interest. We are receiving interest, so that means interest income on a fixed deposit amount that we've got obviously with our bank account. The amount was directly deposited into the business bank account. So the bank that's paying us the interest, they just deposited it directly into our bank account. So our bank account is increasing, so debit bank account. Our general ledger account called interest income or interest received, and you must put the income or received as part of the name, is also increasing. So assets bank is increasing by the interest amount, and owner's equity income, remember there, income increases owner's equity, increases owner's equity. The reason that you must put the word received there is because if we were paying interest, that general ledger account must be called interest expense or interest paid. So in your chart of accounts, you would have two accounts, an income account called interest income or interest received, and an expense account called interest paid or interest expense. So you must specify which, you can't just call it interest, because interest could be an income account or it could be an expense account. So we must indicate which one it is. Okay. That's cash receipts. Cash book payments is the next part of the question. So on this one, you had to identify which of these. Oh yeah, and then they also wanted petty cash. So three different things: cash book payments and petty cash. So you see I've highlighted and marked off those items that belonged in my, oh dear, sorry, that belonged in my cash book receipts. So go and take another color and, what did I do? Sorry. I thought I had changed my color. And then go and mark off which ones belong in the cash book payments. So the easy one here is, let's just mark off the petty cash ones so we get those out the way. So petty cash is going to be on the second. That's not petty cash, so that will obviously be payments. That's not payments. This one, paid petrol from petty cash, that's going to be petty cash. We'll mark that one out of the way. And down here, this one is paid using petty cash, so that we'll get that out of the way. This one was paid out of petty cash, so we'll get that one out of the way. The reason I'm doing that now is because several students put the petty cash transactions into the cash book payments. Petty cash transactions belong in the petty cash journal because you're actually paying those amounts out of your petty cash tin, which is cash that has already been taken out of the bank account at some previous stage, cashed into rands and cents, notes and coins, and put into an actual physical tin on the business premises. So when we make a payment using petty cash, it does not affect our bank account. So only these remaining ones then come out of our bank account itself. So on the first, we paid the monthly installment on a loan. So we are paying a, sorry, let me just, I know I get a bit I like to get these. Oh, no, Heather, you already got pink. Why are you going back to pink? We've got green, we've got pink. What's another color we haven't used? Blue. Okay. So these ones, I want to get some, that's too dark. Light blue, that's better. Okay. So we'll use, oh, that's not much better, is it? So these ones that are going to be in blue are then going to be in our cash book payments. First one, we are paying a 6,800 Rand installment to Absa Bank, which is a loan repayment. So name of payee means who are we paying the money to? Absa Bank. Total in the bank column, how much did we pay out of our bank account? 6,800. So that must always be the including VAT amount if VAT is applicable. No VAT, there's no VAT on a loan. We're just paying back an amount that we borrowed. So because it's a loan, there's no VAT. It doesn't involve inventory, so it must go under our sundry accounts column. So we put it under the amounts column, the full including, I'm saying including VAT, but there is no VAT in this one. And under the details column, again, this must be the general ledger account name. Okay. General ledger, oh, sorry, did I undo that? Account name, not a description. It must be the general ledger account name that we are going to, in this case, this is a cash book payments. So we are crediting our bank account and we will be debiting input VAT inventory and whatever general ledger account we write here under details. So the general ledger name must be, you could have just said loan or you could have said loan Absa Bank. Then on, well, have they got the second 2,600? Oh, okay. Yeah, this is going to be we are making an EFT payment to draw cash from, sorry, for petty cash. So we're not making a payment out of petty cash. We're actually drawing cash out of our bank account. We go to the bank. We ask them for 2,600 Rand in rands and cents, coins and notes. And we take it back to our business and we put that 2,600 coins and notes into the petty cash tin. So our bank account is being credited with 2,600 Rand and our petty cash is being debited with 2,600 Rand. The name of the payee that we use when it's a cash payment that we're making is we just put the word cash. I did accept it if the students wrote petty cash there as well. Then on the third, we purchased trading inventory for cash, so cash book payments. From whom did we purchase it? From Great Books. So Great Books goes under name of payee. What's the total Rand value we paid for the inventory? For 56,000 because she bought books exceeding blah, blah, blah. Okay. So the amount that we purchased was 56,000, including VAT. Remember, it told us all of these amounts include VAT except if they tell us otherwise. But because we bought books where the total Rand value exceeded 50,000, we got a 5% trade discount. Rand, round to the nearest Rand, which means we didn't pay them 56,000, we paid them only 95% of 56,000, or 56,000 minus 5%. So the amount that came out of our bank account was 53,200 Rand. Okay. Remember, this column includes VAT. This column is the VAT only, and all of these columns on the right-hand side here will be the excluding amounts. So because this is a standard rated transaction, we purchase in inventory, we then have to work out of that 53,200. Let me also put this at the top. Remember, because it's the including VAT amount, that will be the 115, that will be the 15, and that will be the 100%. So if I put over here, equals 115 equals 15 VAT column plus the excluding VAT column. This here is cash book payments. This is getting the credit, and these two amounts here will get the debit, so that our accounting equation, left-hand side equals right-hand side, will still be in balance after we have processed all of these transactions when we post them eventually. So here we go. We can say 53,200 divided by 1.15 will give us our 46,261. It goes under the inventory column because it's trading inventory that we've purchased. 53,2 minus 46,261 equals the VAT. Then the next one, we did that one, is on the 21st. Also trading inventory, so it's also going to go under our inventory column. This time the supply is textbooks and more, so name of payee, textbooks and more. Here it is 36,480 excluding VAT, so that 36,480 is going to go under the inventory column because that's the excluding VAT amount. Then we have to take 36,480 multiplied by 15%. 36,480 times 15%. You only ever use times 15% when you are working out the amount of VAT that you must add to the excluding VAT amount. Only in that instance. We never multiply by 15% if we are trying to work out the VAT and the amount that we've got is the including VAT amount. You will not get the right answer. Okay. And then once we know what the VAT amount is, 36,480, 100, plus the VAT, 5472, equals 4192. Okay, because our sum 115 on the including VAT equals 15 in the VAT column plus 100 in the excluding VAT column. So in this case, we were going backwards from excluding VAT plus VAT equals including VAT. Then we've got the 26th. We made an EFT payment to Jacques Ninaber. So name of payee, Jacques Ninaber, the 26th. What's the total Rand value of the payment, which must go in our bank, including VAT column? For the monthly rental of the bookstores. So rental, but remember our rule with rental, I gave you that those things to watch out for. When rental is business rental, it's a standard rated supply and VAT is included. If this was rental for a house that somebody was living in, then it would be an exempt supply. But because it's business rental, that 4,000 Rand is the total amount that went out of our bank account. So it must go in the bank column. But then we must split the 115 into the 15 and the 100. So that we put the VAT in the VAT column and the excluding VAT in the sundry column. So to work out the excluding VAT, when we've got the including VAT amount, we can say 4,000 divided by 1.15 equals 3478. And then we can say 4,000 minus 3478 equals 521. Because we are doing left-hand side equals VAT plus. So if I know what the excluding VAT is, 3478, and I know what the including VAT is, 4,000, if I take 4,000 minus 3478, it will give me what the VAT amount is. Okay. Your other calculation that you could use when you're doing this is 4,000. Remember, I told you exactly the same as our markup calculations. What is the Rand value that we've got, which is 4,000? What is the Rand value that we want is the 100. So times 100 at the top, and the Rand value of what we've got goes at the bottom, which is the 115. 4,000 times 100 over 115, and that will also give us 3478. And then you just subtract these two from each other to get the Rand value of the VAT. And then in this one over here, you did, we've got one last one. We didn't have to do column totals, and we've got one last payment. We paid wages to casual workers that helped during the start of the new semester, 8,800. Wages is not a VAT supply because it's not the supply of goods or services. Okay, we are not selling goods or services, or we are not purchasing goods or services from another business. We are paying somebody for their labor, no VAT involved. The 31st, so again, it's we paid wages, casual workers, that's a cash payment. I did accept it if students put wages, but correctly it should say cash because we would have drawn cash out of our bank account and then paid that cash to the workers. But because here they did say an EFT, I accepted wages there because we transferred directly from our bank account into the casual workers' bank accounts, that Rand value of money. So the total amount that came out of our bank account is the 8,800. Must be the total. And there is no VAT because it's wages. So nothing goes under the VAT column. So the total amount will be, because remember here we are cash book payments, we are crediting bank with 8,800. We will then debit the expense account wages with 8,800. Oh, sorry, I forgot with this rental over here. We are crediting bank with 4,000. We are debiting VAT input with 521 and debiting rent expense with 3478. And then the petty cash, we've just got 3 items there. These are our green ones, the 19th, the 21st, and the 28th. So only those amounts that are paid out of the petty cash box will go into the petty cash journal. There were quite a lot of students that included this amount that was paid into the petty cash box in the petty cash journal as well. No. When we are paying with this one, we are taking money out of our bank account, so it must go into our cash book payments. Only when we pay money out of the petty cash journal does it go in the, sorry, petty cash box, does it go into the petty cash journal. Only payments out of petty cash. So we paid petrol. Sorry, let me go back here. Let's get the green for petty cash. We paid petrol of 950 Rand, but this petrol was for Gift's private vehicle, not her business car, her own private little Mercedes SLK. So the business can't take that as a business expense because it's a personal expense of the owner. So remember, whenever the owner transacts with the business, we then have to use either the capital account if they contribute in or the drawings account if they take in. So here Gift is taking 950 Rand of the business's money for her own personal use. So in our petty cash journal, what goes into the details column is a description of what we purchased. Okay, not who did we pay the money to, but what did we buy. So we write there petrol for Gift's vehicle. This is also going to be petty cash, again, like the cash book payments. Your main column will be including VAT. Your input VAT, we are going to claim back. That is the VAT only. And then all of our expense columns on the right-hand side here will be the excluding VAT. And excluding VAT and internet fees, this is also excluding. Okay, because remember again, what we are doing is, in this case, it's petty cash is going to be main column equals the credit that goes to petty cash, Rand value on this side, this is the left-hand side of our journal entry, equals, and then it must be VAT plus the internet fees must equal the total amount that came out of petty cash. So either VAT plus internet, VAT plus staff, or VAT plus this amount, okay? So whatever we write on this amount, 157 plus 103, must equal what goes in the petty cash column. Whatever we've got on this side of the equal sign, which in this case is only 950, must be the same on the left. Whatever we've got on this side, which is only 276, must be exactly what we've got on the left-hand side of our equation. Always write that. You're welcome to write this all over your answer paper. You're not going to lose marks. These would be counted as workings. I want to see your workings, and these workings are going to help you to get your answers correct. So write whatever you want to all over the paper. So the amount that came out of the petty cash box in total, including VAT, is 950. So we're crediting the petty cash box with 950. And because it is the amount, it's not internet fees, it's not staff refreshment, so it must go under sundry accounts, the total amount. And the account that we will be debiting is the owner's drawings account. So we write there drawings. Not petrol, because it's not a business expense, it's an owner's personal expense. So we must decrease the owner's equity by debiting the drawings account. And there's no VAT on petrol, so even if this was a business petrol expense, we still would not put anything under the VAT column. Okay. Then on the 21st, that's not the 21st, it's the 25th. This over here is the 25th. We purchased a kettle from Thomas suppliers for the staff to make coffee during their breaks. So this kettle is not going to be used in the business to make whatever goods. What is this? Is a bookstore. We don't use this kettle in our actual business to produce sales for the shop. It's not a business expense. It is a private expense, if you want to call it that, because the business is going to use it to make tea and coffee for the owner and for the employees. So therefore, it's a non-allowable transaction. We can't claim the VAT back. So that full 276, because it is the including VAT amount, must go under credited to the petty cash column. And under details, what did we purchase? You could have just put their kettle, or they've got whatever they've got there. It's fine. We purchased a kettle. But you must write kettle, not Thomas suppliers, or not only Thomas suppliers. No, nothing under the VAT column because it's a non-allowable purchase. So the full amount, and a kettle is not staff refreshments because we can't eat the kettle, although it's also maybe just a technical thing. What we've actually purchased is a piece of equipment or a fixed asset, or you could have put under details here kettle as well. That's also acceptable. And the full amount, 276, must go under the sundry accounts. So left-hand side of our equation, 276, right-hand side of our equation, 276. We're happy that our accounting equation will still balance after we've processed this petty cash journal into our general ledger. And then on the 28th, we bought data from MTN, also from petty cash, total rand value of 1,200, including VAT. Data cell phone usage is a standard rated supply, so 1,200 includes VAT. And it is the business that will be using this data. So therefore, it is a valid business expense because we have to phone our customers and our suppliers. So we can claim the VAT back. So 28, what did we purchase? You could have written here data from MTN or whatever, but it must be what we purchased. The full amount, including VAT, goes on the left-hand side of our equation under the petty cash column. Then we have to work out on the right-hand side, split the 1,200 into the VAT and the excluding VAT amount. If you want the VAT only, and what we're starting out with is the including VAT amount, your maths is 1,200 multiplied by what percentage do I want, which is the VAT, which is 15, over what percentage have I got, which is the 115, because it's the including VAT amount. Okay, 1,200 times 15 over 115 would give you 157. 1,200 multiplied by 15% will not give you 157. Okay, 1043 times 15% will give you 157. Excluding VAT amount times 15% gives you the 157, and then you take 1043 plus 157 equals 1,200. Okay. We could also have worked out our 1043 here. If we only knew what the 1,200, we could have said 1,200 divided by 1.15 would give us 1043, or you could say 1,200 times the amount that I want must go at the top. I want the excluding VAT amount, which is the 100, over the amount that I've got at the bottom, which is the including VAT amount, 115. So that will also give me 1043. Practice over and over again doing these calculations. Write your little equation up at the top. Your main column of whatever journal it is, if it's a cash book, if it's petty cash, if it's debtors ledger, if it's creditors ledger, your main column here will always be standalone one, including VAT, and will always be the left-hand side of the equation. So your main column, and you'll always put the equal sign next to your main column, and then everything on the right-hand side must then be what adds up 157 plus 103.43 must add up to equal the main column, and whatever the main column is will depend on which journal we happen to be doing. So this is the petty cash journal, so our main column is petty cash. And because we are paying money out of the petty cash, which is an asset, is getting the credit, and everything on the right-hand side of the equal sign will be getting a debit. Okay, which is why your debits, 157 plus 1043, added together must equal the credit. So it's those same principles that you continuously applying over and over again. Okay, so we've done all of question 4. I know this is going to be a long video, but if you guys do listen to it, it's definitely going to help you. Just reinforce over and over and over again what we've been doing all semester. That category memorization, that calculations, practice, practice, practice. Markup on selling, markup on cost, practice, practice, practice those calculations. And also practicing what goes into which column of all of the different journals. And it's only practice that will get you there. Okay, I'm going to try and hurry up with the rest of this because my throat is starting to fail me with all the talking. 5.1, calculate the totals marked A plus B in the cash books above. Sorry, not A plus B, A and B. So exactly what I've just said to you, this is cash book receipts, this is cash book payments, which means our equation rule is that bank main column will always be the including VAT column, and everything on the right, sorry, that will be, that's the actual VAT itself. Sales will be excluding VAT. Sundry amount will be excluding VAT. There's your calculation. Main column, left-hand side of the equation. All your columns to the right-hand side, output VAT, sales, or sundry. Those three added together, output VAT plus sales plus the total of all of the amounts that I put into my sundry accounts will equal my total on the left. Okay, main column equals the columns on the right hand side, but only those columns where I entered the main, what should I say, the sales rand value of whatever sale I made in cash book receipts. Okay, remember we did what did we do in that other question? When we did question 4 and we did those 2 sales transactions on the 8th and on the 11th in question 4. Okay, we said there are 2 journal entries that we've got to record when we make a sale and we use a perpetual inventory system. The first one is the actual sale itself. So debit bank, credit output VAT, credit sales. And there's a completely separate second journal entry that we do which is then going to be recording the movement of the inventory. It's a completely separate transaction. In your books, in your textbooks, there's a space between the cost of sales column and whatever was in the columns to the left of the cost of sales column. They deliberately put it like this to check that you guys are paying attention and that you know cash book receipts, my bank account gets the debit. My VAT will get a credit. Can I go back here? Oh, no, sorry, I got it up here. My excluding VAT column will be a credit. My sundry accounts column will be a credit. So whatever these credits are on the right-hand side, the credits added together will equal that debit. Cost of sales, that amount is going to be debited to my expense account cost of sales and credited to my asset account inventory as a separate standalone journal entry. Okay, so if you look at 5.1 on the right-hand side here where the memo is, the value for A is 14,184 plus 94,562 plus 60,150. And for B, because we've got that same principle, my main column, which is bank, equals my VAT plus my excluding VAT amounts. And because this one over here is our cash book payments, bank is going to get a debit because it's increasing. VAT is going to get a credit because it is input VAT that I'm claiming back. Trading inventory is going to get a credit because, what's this one? Cash book payments. Oh, other way around. Sorry, guys. This is quickly go back before I confuse you. This is cash book payments. So my bank account is decreasing. Bank account is getting a credit. That is input VAT. I'm claiming that back. So it's an asset, which is a debit. And I have purchased trading inventory. So trading inventory is increasing. It will get a debit. And whatever expenses I'm paying for, expenses get debits. So, or if it's other assets that I'm purchasing, sundry amounts will also be a debit. So in my cash book payments, bank gets the credit on the left-hand side of the accounting equation. And on the right-hand side of my equation, everything else will be debited. Exact mirror image of my cash book receipts. Cash book receipts, bank asset increases, gets the debit, and then everything on the right-hand side is then a liability of some kind or an asset that is decreasing, so that gets a credit. So for B, it's quite simply just 24,463 plus 157 plus 25,8, that those three added together equals my value for B. Then you were asked to explain what the analysis of receipts column is. Remember, guys, I think we did discuss this. Your analysis of receipts column in your cash book receipts is only there to record an amount of money when you receive actual money or a payment at your premises, and that money hasn't yet gone into the bank account. Then we put it into the analysis of receipts column. Remember, we said it's called the till column. We received the money, we've put it into our till, but we haven't banked it yet. When we bank it, we then add up all of the analysis of receipts column amounts, and then that total is then transferred, put into the bank account to show that the money is now in the bank account. So it's almost like a holding column. When we receive it, we put it in the analysis of receipts just to remind us, hey guys, we received money. Remember, this has to still go and be banked. And then when we bank it, and only when we bank it, can we put that amount into the bank column. You can't put the amount in the bank column if you haven't yet banked the money. Okay, bank means it's in my bank. So any explanation that showed that you understood that. And then you had to do general ledger accounts. We had to do bank. We had to do trading inventory. We had to do capital. They gave us an opening balance. They gave us an opening balance here, and they gave us an opening balance there. And then the last one we had to do was sales, and we also had an opening balance there. So these four general ledger accounts. So when we talk about a general ledger account, that is our T account. T account, okay, because it looks like a T, because we've got a line across the top, a line down the middle, with our debits that are going to get recorded on the left-hand side and our credits that are going to get recorded on the right-hand side, and the name of the account that will be written across the top of the T. Okay, that is the format, excuse the scribbles, of a general ledger account. So that's what we wanted. So these four: bank, trading, inventory, capital, and sales, you had to use these. So remember this question too, these are column totals. At the end of the month, for the month of March, the totals, okay, so what they didn't do was give us all the individual transactions for the month. They have just given us the column totals for the month, as if these columns had all been added up. These were the totals, okay? So we know that at the end of every month, when we've finished entering our journals, we total all of the columns, and then we post the totals into the general ledger. Okay, that's the next step in the bookkeeping cycle, which you will find very, very important on page 18. Journal summarize the source documents. So that's what we did here. Cash book payments, cash book receipts. We summarized all our transactions from the source documents. We totaled them, and the next step is then the general ledger summarizes the journals, which means post the journals into the general ledger T accounts. Post the totals, column totals of the journals into the general ledger accounts. Okay. So let's just have a quick look at what these look like. Let's make this a little bit smaller. I don't want to make it so small that you can't see it, but I don't want you to be able to see as much as possible. So the first one is the bank. They said it's an opening balance of 300, and it's a favorable balance. Bank is an asset, so if we've got a favorable bank balance, it will go on the debit side because bank increases on the debit side. You did have to fill in the dates, the details, and the folio in order to get all of the marks. Then we had to go here, cash book receipts. So by how much did our bank increase? And that will be our value for A. So whatever total you got for A, you then had to put on total receipts. CBR from my cash book receipts, 168,896. 168,896. Okay, bank is debited when it increases. Cash book payments, bank, my total payments will decrease my bank account. So on the right-hand side of my T account, details is total payments. CBP is the folio, and then 207,548, which is the total of the bank column, your total for B. And that's all that goes into the bank account. That's why we say the general ledger summarizes the journals, because we are using the summary column total for bank, and only that total gets posted into the T account bank. Because now look, our bank account in the general ledger is all nice and neat. I can clearly see exactly how much I received in the whole month into my bank account. I can clearly see exactly how much I paid out of my bank account for the whole month. And I can see that that came from cash book payments. This total came from cash book receipts, so I can cross-reference and go back to my journals if I want any detail. Because the journals hold the detail, the general ledger holds the summary. Then you had to balance the account. So in order to balance an account, you add up the left-hand side and you add up the right-hand side. In this case, we've got 468,896 on the left-hand side. We only had 207,548 on the right-hand side. So because 468,896 is the bigger amount, we write that amount down on the left-hand side and on the right-hand side, leaving a space between that amount and the total for us to then work out what the difference is between the total debits and the total credits. So it's total debits 468 minus total credits 207,548 equals the balance left in my bank account. So the only reason that we do this here is to work out what this balance amount is. Because it's a positive balance, my debits were more than my credits. That amount is then carried down as my opening balance for the beginning of the next month. Okay. So just as the top over here on the 1st of March, we wrote down 1st of March balance brought down and the amount that they gave us as the opening balance. We've now calculated for the 1st of April balance brought down what that balance amount is going to be. This, and that, and this total here is the workings for what that balance is. And because the debits were more than the credits, we write that balance down on the debit side. Okay. Inventory is also an asset, so we're going to do the same thing. Inventory, they gave us our opening balance of 13,000. You'll never have negative inventory, so it has to be on the debit side. Positive balance in my, so also 1st of March, balance brought down and what they gave us. Then we go over here to cash book receipts. Where will I find my transaction for inventory in cash book receipts? Remember, cash book receipts is where I record my sales. When I record a sale and I'm doing the perpetual inventory system, I've got this column headed cost of sales where I'm going to debit cost of sales and credit inventory. So I know that the 72,740 over there, debit cost of sales, credit inventory. So here's my inventory account. I must credit my inventory with that 72,740. What we write in the details column is the name of the general ledger account that is going to get the opposite side of the entry. So credit inventory, debit cost of sales. Folio is which journal did this transaction come from? CBR. The date will be the 31st because it's at the end of the month that we post our column totals from the journals into the general ledger. Then in my cash book payments, I have got the total of all of the inventory that I purchased in the month. So the total that I purchased, excluding VAT, is the amount by which my inventory account is going to increase. So on the debit side of my general ledger account, again, it's happening at the end of the month because I'm posting month-end column totals. My inventory is increasing by 157,253. That is the amount. Oh, what am I doing? It is the amount, total amount by which my inventory increased through all of my purchases in the cash book payments. Debit inventory, credit bank. So under details, I write the name of the general ledger account that is getting the opposite side of the entry. Okay. Debit inventory here, this is my inventory account, so I'm writing the amount by which I'm debiting to inventory here on the left-hand side, and I put the name of the account that's going to get the credit under details. Folio is CBP because this journal entry comes from the posting of the totals from our cash book payments. Then we do the same balancing act. So I add up my opening balance plus my new purchases, 170,253 on the left-hand side. I add up my credits, which at this point is only 72,740 on the right-hand side. So my debits are more than my credits, so I write 172.53 down on the left-hand side, and on the same line, I also write it on the right-hand side. You'll see that must always be on the same line so that I can see that this is my balancing workings, and that will always then leave a space between the total credits and, in this case, my total debits. I subtract total debits minus total credits equals 97,513, which then means that that is the total debit balance left in my inventory account, which I am going to carry down. And because the debits were more than the credits, this 97,513 is a debit balance. So for the 1st of April, I write down balance brought down. Sorry, this is an error in this memo as well. Where's my, sorry, let me just get my version where I've corrected this. What was this? Petty cash, inventory. Yeah, this over here. Let me just correct this for you. It's not 188. That amount is 97,513. That's just a typo on the memo. Okay. So this is the calculation of what the balance is, and we then carry that balance down. That's the balance that must get carried down. We're doing this calculation on the 31st. I work out the balance that must be carried down, and on the 1st of April, I write down the balance that was brought down. This here is 97,513. Okay. Then our capital account, trading, here we go, capital account, opening balance of 500,000. Capital account, dead, click, those accounts that increase on the credit side, liabilities, income, capital. So that 500,000 must be on the credit side because capital increases on the credit side. So on the 1st of the opening month, 1st of March, the balance brought down was 500,000. Then what transactions in our cash book payments and cash book receipts did we post to capital? So that's our main column, bank. Nothing from there was no receipt to capital. No receipt to capital, so there were no new contributions. Okay, nothing there. So nothing that's coming from the cash books. What else did they tell us? They said, assume an opening balance of 500,000, and that included in the sundry accounts column Because remember above over there, I'll show you again, in the cash book receipts, they've only given us the total for the sundry accounts column. We can't see what all the individual general ledger accounts were making up that total. And they've told us included in that, there is a capital contribution of 60,000. So if we go back here to our cash book receipts here, this sundry accounts 60,150 is the total of all of the amounts that were credited to various sundry accounts in the sundry column. And they've told us that of that 60,150, 60,000 was a contribution. So capital increases on the credit side. So at the end of the month, we are crediting capital with an extra 60,000, and that transaction is coming from the cash book receipts. And again, cash book receipts, we are crediting the capital account, and the bank account is getting the debit. The opposite side of the entry, the debit, is going to bank. So we write bank under details. So debit bank, credit capital. Okay. Credit capital with the increased contribution, debit bank account with 60,000. And in this case, there's nothing on the left-hand side, nothing at all. All we have to do is add up to get the new balance on this side. You could have then underneath this put there 1st of March 23, balance brought down 560. But yeah, we've got 560. That is our balance brought down. You didn't have to write anything else. And then you'll see on the sales general ledger account as well, sales is income. Sales is only a credit, nothing on the debit side of sales, because sales is an income account. We only ever credit sales. Bank, we sometimes debit bank when I put money into my bank account. We sometimes credit bank when I take money out of my bank account. So bank account, I can have debits or credits. Inventory, also, I sometimes purchase new inventory, so I can debit inventory. I sometimes sell inventory, so I can credit inventory. My capital account will only ever get credited. If the owner takes capital out of the business, we debit the drawings account. Never any debit to the capital account. My sales account is an income account. We will only ever credit sales. If I have a reversal of a sale, I will use my sales return account and debit that. Sales will only ever get credited. So cash book receipts, they gave us our opening balance, 1st of March balance brought down 236,405. That was given to us. And then in my cash book receipts, I've got my sales column here, 94,562. That was my total sales for the month. 31st of the month, debit bank, because my bank increased with that amount of sales, credit my sales account. Okay. With if you are just a bit confused with why we are debiting bank with 94,562 and not, because this 94,562 is the excluding VAT amount. I am debiting bank, crediting sales with 94,562. I am debiting bank, crediting output VAT with 14,184. So all of the output VAT in my T account, output VAT, you will see the balance of the amount that in total was debited to the bank account. Okay, the credit to output VAT plus the credit to sales will equal the total that was debited to bank for my total sales. Okay. Go and have a look at your textbook where they've got these full questions, and go and have a look at your sales, and go and have a look at the output VAT, and trace that back to your cash book receipts so that you can see what I am referring to there. And that is the end of the assignment. It's quite long, but all of these things are items that you're quite likely to come across in the exam. And we are just, again, revising all of those calculations, transactions, how do your various journals work, etc. So you guys know what you've got to practice. So really, honestly, guys, it really does come down to just practice. Okay. Okay, so I am going to end the recording here because I'm sure it must be very long by now. Stop recording, and then I will post this for you guys to be able to go through it in preparation for your exam. Again, all the very best of luck, guys. Thank you. Cheers.